Welcome to the SIWIKE Podcast, the only podcast that shares the stuff you didn't know you needed to know about jobs, careers, and life. The SIWIKE Podcast, the stuff I wish I knew earlier.
Hi, everyone, and welcome to the SIWIKE Stuff I Wish I Knew Earlier podcast. We're here again with one of our guest hosts, Revant, and today we thought we'd talk about money, right? We'd talk a little bit about financial literacy, about our experiences with money, and a whole bunch of concepts that we think that folks should learn in their youth or as early as possible, and then bring with them as they're older. So I'll give it a start. I probably learned money at a fairly early age, but not too much in terms of the overall concept. So my dad gave us an allowance, right? We had this weekly thing called bank, right? So we had this little pocketbook with like a little notes on how much we would save, but it was really just a lesson in money because there was no money, no real big money involved. My allowance when I was, I think, like 10 years old was a quarter. This is 25 cents a week, right? And then it went up, and over the course of the year, it would kind of double. And then I think my sister, who was 4 years older, got something like $5, right? So we got like a quarter, and then like $1, and then $2, and then $5 or something like that, right? And essentially what he would do is give us a quarter, and then we could see some interest happen. So he said that we got like a penny for every dollar that was in there. So like 1% interest, and we could just see the money going up. So I thought it was fun because to be 10 years old and get little quarters there, and you could physically see it and you'd write it in a book, it was a little bit fun. But if you thought about it, like $5 is even when you're like 15, 16 is nothing, right? Like you can't really have that. And I didn't live in the age where I don't know, you could buy things for a quarter or whatever, right? It wasn't that cheap or anything, but it was just more a lesson in money. So that was kind of my first kind of foray into it. But I didn't really learn anything more until I was probably in the workforce. So maybe 25, 30 was when I really started understanding it. And yeah, I heard about all these things, but I didn't really pay attention to that much. But we'll start getting into some of these concepts. But I'd love to hear kind of your background. Like, how did you start learning about money, and what are some of the things that you feel that folks should know about?
So similarly, I was also given an allowance, but I think I would save at least 80 to 90% of my allowance and just, like go and deposit it in the bank at the end of the month, because I always believed in compound interest. And I got introduced to this concept quite early. And like I would see, like I would try to mimic what my dad did, like how much ever money he would get, like he would start putting it in the bank or like start investing. And for me, like probably at the age of 10, 12, like I didn't have enough knowledge to like go and invest in different asset classes, financial assets. So probably the easiest thing for me was whenever I used to get money, maybe on some festivals from relatives, grandparents, I would collect all the money and go and deposit it in the bank, because that's a reasonable sum of interest I would get, like something like 6-7%. And like at the end of the year, I would go and I would be so excited and I would be thrilled to know how much is my book value, like towards the end of the year. So that is one thing which I would always wait for the financial year to get over and for my interest to be credited. And that is something really exciting for me.
So can you walk us through kind of that first time you learned about compound interest and that feeling of, ooh, I have more money than I deposited? Like, what was that like? Did your dad actually like sit you down and say, hey, son, this is compound interest and this is why it's important? Or was there like a different way that you learned it?
No, I think I got introduced to like simple interest and compound interest probably in my 5th grade or something. I mean,
Okay.
It was probably just using basic formulas and, like we used to do mathematical problems about those. And I really never, like cared about it, like, or try to apply it in my life. But then one day, I think I was just sitting with my dad and like I got confused between simple interest and compound interest. I remember that day. And like he told me there's a big difference between simple and compound. And then he sat with me and he explained to me how compound interest like how big a difference compound interest can be. Like at the end of 1 year, if you're getting 10% interest, like in simple interest you keep on getting the 10, but in compound, first year you get 10, next year you get 11, and that's how you keep on multiplying your money. So that was something I was like mind blown with that at that point. So I was like, okay, cool, I'm only gonna go for compound interest, gonna go and save every penny and put in the bank, because bank was the only place where it gave me compound interest at that age.
Yeah, I think folks need that aha moment where I mean, I don't think I understood that like well into my 30s, right? Like I understood the concept that yes, you get more in compound versus simple, but when you actually have that example with numbers, right? And actually go, well, if you start at 20 and do that versus when you start at 30 and do whatever, then there's a huge difference. I think being able to see that in either a visual or like an example or something is so important because yeah, compound interest is one of those things. I think Einstein called it like the seventh wonder of the world or eighth wonder of the world or something like that, because it is amazing. So talk us a little bit about what you learned more about money, because I think you mentioned things like budgeting, spending, and like making sure you don't spend more than you earn. So how did you learn some of those concepts?
So I think I've always seen growing up, I've always seen my dad, like how he manages his expenses, his salary, and like all those things. So he always believed in not having any debt.
Mm,
So luckily for us, like we were not in a debt trap, because like many of our relatives used to keep on taking loans to fund their spending,
right.
and then there wouldn't be a significant inflow to their accounts, and then that would lead to like many money problems, and then someone else would have to come and fund them. Like you can't rely upon those things. So
Right.
um, that's how, like, I think this one rule, like recently I read about it. It's called the 50-30-20.
Hmm.
Like so it's like 50% of your income after tax, you should spend it on your basic needs. 30%
Right.
of the money you should spend it on your wants, something you desire, something like an EMI of your car, or like maybe a vacation. You can have the leisure of spending that 30%.
Sure.
But I believe like the most important aspect is the remaining 20%, which is the amount you should which is the 20% of your income you should be saving and probably investing, or into some debt instrument, or like equity, or like whichever kind of financial instrument you understand. Because this 20% is a part which will help you ease your future cash flows and reduce the burden of your debt in the future.
Yeah, I think what's important is that people don't really talk about money, right? It seems to be like a taboo subject. If you're to ask your parents or your friend, like, how much do you make? It's like, oh, that you just swore at them, right? You just kind of told them off because that's not something people talk about. And I think that's not a good thing, right? Where folks should be a little bit more proud and open to talk about that. And it'll be a bit of a culture shift to do that. And I think having those conversations at a younger age helps build those good habits, right? And you get that compound interest effect where you can grow and earn. So I think one thing that stuck with me when I was reading some of those financial books was that um, being rich is saving more than you spend, or having more than you earn. And the simple thing is being rich is making $1,000 a month but spending 900, right? And being poor is making $10,000 a month but spending 11,000, right? Because it doesn't actually matter how much you make, it matters how much you spend. And people talk about budgeting and things like that, and I found that a lot of people have this adverse reaction to budget, right? It's almost like it's restricting. I can't do things. I'm locked down. So I've actually talked to people about calling it instead, call it a spending plan. Like being conscious, how do you spend your money? So as you mentioned, 50% on your needs, 30% on your wants, and 20% on savings is helpful, right? And I find it's challenging nowadays because everything is on credit, right? So you can actually spend money that you don't have yet, right? So I encourage folks to, instead of calling it a credit card, call it a convenience card, right? So it's one where it's hard to go around without spending on some piece of plastic, but only spend if you have that money, right? So making sure that before you make that $50, the $100, whatever purchase, make sure that you have $50 in the bank so you can pay it off. So it's using it for the convenience versus the credit, because as you said, if you're in that debt cycle, well, debt compounds into more debt. So just as it would compound into more savings, debt also does the same thing. So that's not a great thing for folks to have. So tell me about kind of your first foray into savings. So you said that you took some of the money from your festivals and stuff like that, and you put in an account. Was it just a regular bank account? Did you actually put in an investment, or what was that experience like?
Yeah, I think it was actually more complicated for me to understand it at that age. But the Indian government had this scheme wherein you can deposit a certain amount and that will be tax free, but it's like a maybe a 10 or a 15-year lock, and you can choose between one of them.
Okay.
So I knew that every penny, whatever I'm putting in my bank account right now, I'm not going to be able to withdraw it at least before I'm 23 or 25, something like that. So I mean, because like when you actually feel the money in your hand, and when it's digital money, the like most people have a different approach to that. Like cash in hand is always looks better than cash in the bank, but I feel that's not the case. So yeah, so my first so it was a tax-free instrument, and like even right now I keep on putting some money into the same account, just so that I'm getting a very good return, at least 8 to 9% interest, which is super high.
Wow.
Like pre-tax, because post-tax, I mean, if you add the tax, it becomes like 13% return.
Wow.
So that's a very good return. So that's why I believe in that. And nowadays, I don't think so too many debt instruments would give you such a high return.
Yeah, I think it's taking a look at what's available in your country. So in Canada, we have two main concepts, like the TFSA, the tax-free savings account, and then the RRSP. So both hit, I think when you're 18, you get access to them. And the main difference is the TFSA is after tax, right? And then the RSP, basically you take off your earnings so that you have to pay less tax, right? So it's really just tax deferred, right? So if you're making a lot of money, generally you want to put it into your your RSP to max it out. But there's also a case to put in your TFSA if you find that your return can compound. And then in any of those accounts, that's just how they're set up. You can still invest in different things like stocks or bonds or mutual funds and things like that. So I know that you have a practice of kind of actively trading and stuff like that. So can you walk us through kind of your first few experiences doing that, and then your thoughts on using that as kind of an investment vehicle or a way to kind of plan for your future?
I think that would be my success to compound interest now. Like the change in approach would be that when I was probably 10 or 12, my approach to compounding was I only had access to a bank account.
Sure.
But now looking at different tools, learning over the years, and like reading about companies and what they do, looking at the fundamentals, feel I have a little bit more knowledge than before about investing in the stock market, or like looking at debt instruments, looking at mutual funds, investing in cryptocurrency. So like probably this will be my like method to compounding my money now. But yeah, like I have been actively trading since so I have what I did initially was that I got a sum of money from my mom, out of which 50% I deployed in like some good quality stocks which are going to be for long term, and 50% of which who I trade right now, like maybe hold a stock for a week, for a month or something, until my target is achieved. So so probably that by that now I try to fund my day-to-day expenses. And yeah, I think, and if something is left, now I don't take any pocket money from my parents, because I think I'm old enough now. And if some money is saved, then I put that into like the tax-free account which I mentioned earlier.
That's amazing. And yeah, I want to caution folks about kind of actively investing, because they're usually what happens is if someone's making money on the stock market, someone's losing money at the same time, because it's a buy and sell model. And oftentimes you can't beat kind of those very well-informed kind of investors and things like that. So what I encourage folks to do is just being aware that in honesty, like putting in your money in the stock market is kind of like informed gambling, right? So you probably have better odds than the house, but the thing is, you are betting against these very advanced and wealthy and educated folks. So you just have to be aware of that their mentality as well. So I think it's great where you have money that you want to make sure is returning, and then you have this one where you're kind of playing with it, right? So if you lose it all, well, that kind of sucks, but you're kind of okay to do that. And if you can make money, that's amazing. And for folks, there's differences in things like stocks and bonds, right? So bonds tend to be a little bit more longer term, a lower interest rate. Stocks are a little bit more volatile. They can go up and down with the market. There are things like mutual funds where essentially they group a bunch of stocks or bonds together, you, instead of buying one single stock, you kind of diversify is the word that most people use, right? Where you invest in a whole industry or sector instead of just one single company. So hopefully in that regard, you make money with the market instead of just with an individual stock. And then they have these actively traded ones, like Revant is kind of doing, where there's managers that actually buy and sell on a regular basis. And then there's these index funds that kind of grow as the market or that segment or whatever grows. So taking a look at what your risk profile is, because obviously the higher the risk, the higher return, but also the likelihood that you'll lose something as well, right? And often the lower the risk, the lower return, but you're likely to be able to retire with whatever you put in instead of losing it all. So yeah, taking a look at that, and you can still use them under an RSP or a TFSA in Canada or whatever country that you're in. There's different programs or different vehicles for you to do. And then on the topic of things like crypto, right? That is a totally different realm on its own, where a lot of it is speculative, right? There's a lot of money to be made there, and also a lot of money to be lost, right? So again, it's always a buy and sell. So if you're making money, someone's losing it, and if you're losing money, someone's making it, right? So just be aware of different motives in that. I wanted to talk a little bit about different concepts. So in financial goals, some people say that they want financial security, right? They want to be able to pay for their basic needs, right? Some people want financial independence, right? Where they have kind of that savings, that nest egg in case anything goes wrong. And then some people want financial freedom, where they can basically pay for whatever wants they want, right? So I don't know if you've heard the topic of building assets to let your money work for you. And I think that's what you're trying to do with your savings account, where essentially you don't have to take money from mom and dad, because your investments are funding you, right? So what are your thoughts about that? And are there different areas where you can kind of share in regards to building your investments that way?
So I'd say that my opinion on some things which I have done for financial literacy could be, um, firstly, like I create a budget every month to track, how much money I'm getting and how much I'm spending it on things. And in fact, there was when I was in Canada, I used to use this app. I forgot the name, but it used to classify every expense and create a chart as to what I'm spending. So I had to manually enter every expense, and towards the end of the month I would regularly go and check, like, this month my expense was more in this part, okay, so that I'm aware the next month, like, I can't go to Timmy's and have like $15 of food every day, right? Something like that. So my advice would be to first create a budget. Second, in case you have any debts, like something like a student loan, then some money should be definitely allocated towards paying that, and so that it doesn't burden you too much in the near future.
Mhm.
And thirdly, it would be like to invest. After these two have been done, if you have some money left, then I would recommend you to invest it. Um, Maybe do something like an SIP, by which like invest in the assets, as I said earlier, like which you understand and which you believe in, like so that it will reduce the burden from your future expenses, right? In case you want to buy a house like 5 years down the line. So this savings and the returns on the savings could help you decrease your burden in the near future.
And an SIP,
Yeah, so SIP is like
what does it
every
stand for?
month you can SIP is something like systematic investment plan,
Okay,
and
yeah.
it's like, so every month you allocate some amount of money from your salary, or like, and then you invest it regularly in the asset class which you decided in.
I've heard it
Uh,
as an ASP, an automatic savings plan. So yeah, it's a similar concept. And I
yeah.
would actually change that a little bit. So from my perspective, what I encourage you to do is to save and save first, to pay yourself first, right? Because unfortunately, what normally happens is if you wait till the end of the month or the pay cycle or whatever to take your money, there's nothing there. Like I've done that multiple times when I was like first started working. I would say, yeah, I'm going to save a whole bunch, but then at the end of the pay cycle, it's like I don't have anything else to spend. So, or sorry, anything else to save. So what I started doing is they call it pay yourself first, right? So the $100, the $1,000, the 500, whatever it is you can manage, put that and save first, right? And then you'll find that you can live off of whatever you have, because if you have an extra $15 in the bank, it's probably going to Timmy's or somewhere, right? But if you don't have it, then you'll make do with whatever's in the fridge or in the pantry or whatever, right? So that's to kind of make sure that the saving becomes a priority, and start with whatever you can. So with $10, with $100, whatever you can manage, and then grow from there. There's also another concept called save more later, which is when you know how much money you make. So let's pretend that you make $1,000 a month, just for easy math, and then you somehow get a 10% raise. So now you're getting like $1,100 a month, right? So that extra $100, you take half of it or some portion of it and put it to your savings, right? Because you're already living off $1,000 a month, so you don't technically need the money, but you can take part of it. So you have now an extra $50 to spend, and then that other $50 goes to savings, right? So that save more later comes in whenever you get some sort of increase or a windfall. So whenever you get money over the holidays or whatever from the aunties and the uncles or whatever, then take half of it or take a good portion of it and put it towards savings, because that'll help. And then compound interest kicks in, right? So if you start at 20 versus 30 versus 40 or whatever, then it starts growing and growing. And one concept that I've actually started sharing with folks is buying with interest, right? And what that is there's something called the rule of 72, which if you take 72 divided by your rate of return, that's how many years it takes to double, right? So if you had your 7%, 6 to 8% investment vehicle, then basically in 10 years, that money would double, right? So next time you're out for a Timmy's, a Starbucks, whatever, so that $15, if you're 20 something, would compound up till 60 4 times, right? So it's, if that $15 Timmy's is not $15, it's 30, 60, 120, 240. That's a $240 meal at Timmy's, right? And as much as you might want that meal, that would be a ridiculous amount of money to spend on one single meal. So just thinking about that as another way to kind of change your mindset as you start investing and saving a little bit more and things like that. But yeah, so that's another concept that I found was helpful. For what are some other things that you learned from an investment or a money perspective that you think would be useful to share with folks?
I'd say one of the things, as I mentioned earlier, like never spend more than what you earn. And secondly, even with the gains, what you get, like just be satisfied. You can't like optimize every trade or like get the get the highest profit possible. Like at some point, it's necessary to be satisfied with what you've earned, and like not have that fear of losing out too much, and just like reinvest that whenever you want to, or like just keep it with you and use it.
Yeah, and make sure you're taking all this based on our experience. None of this is financial advice, so you have to speak to your financial advisor for your particular situation and all those caveats and things like that. But hopefully we've given you some information that would be helpful. So the basics are to start saving early. However you decide to do it, pay yourself first, save more later. Definitely what you mentioned about not spending more than you earn is definitely that key one. Then you can think of optimizing it with different tax or savings or investment vehicles like the RRSP and TFSA in Canada, or whatever is in your country, and taking a look at things like stocks or bonds or even crypto if you don't mind gambling a little bit and seeing if that can return something. And then ideally, if you can build an asset, right? So that money that you save in, if it's giving you a 5% return, well, could that 5% turn into something where it's actually now a source of income, right? Because if you can build that asset long term, that's why a lot of people invest in real estate, and then they buy a property based on some savings from a down payment, and now the tenant is technically paying for your mortgage, right? So that extra money is now being put in, and you introduce cash flow. So those are some things that I encourage folks to think about. But at the end of the day, just start learning a little bit more about money and being educated and seeing how you can make that work for you. And if you have kind of a money-minded friend, ask, because most people are very willing to share, and I think we need to have more conversations about money. Now, I don't suggest you start by asking them how much you make, but learning more about the concepts and all these different things like savings, convenience cards, and what have you. I think that would be helpful. So any parting words in regards to finance and money management, Revant?
I'd yet say that compound effect is really magic. Like when you understand what compounding is, I think it will really do you amazing wonders in the near future.
Yeah, I think that's
So believe in it.
Yeah, I think that's a good place to start. And my addition is that the cool thing is that compound interest doesn't only work for money, right? So if you invest in yourself in terms of learning and growth and stuff, then you also grow exponentially too. So just be aware of that. So thanks, Revant, for joining us, and look forward to seeing you in a future episode.
Thanks for joining us on the SIWIKE Stuff I Wish I Knew Earlier, the podcast. If you like the podcast, please subscribe on iTunes, Stitcher, or wherever you found this podcast. And if you can give us a review, that would be very appreciated. Feel free to contact me on LinkedIn at Lukidanu, Lukidanu, and the same on most social media platforms. And I look forward to hearing from you. Thanks. Bye.